Let's talk about the proper use of stops. The overuse and misuse of stops is probably my #2 pet peeve with retail traders. In case you're wondering, my #1 pet peeve would be setups. Anyone who tells you they need the market to set up before they can trade doesn't have the first clue about the market. But that's for another day. Let's talk about stops. Most of the problems with stops is derived from the fact that most traders were never taught how to properly read the market. That, combined with the fact that most traders are using lagging methods or indicators, only complicates the problem. Stops are a great tool when used properly, but most traders, because of their lagging mentality, and it's not your fault, they place them in the wrong spot, which causes you to get stopped out frequently, oftentimes to the tick or not much more, and then you see the market rip in the way you had originally intended. That's sad, and it's unnecessary. We don't do that. We don't do that at all, and I encourage you to watch for a while and ask questions and attend some of our webinars after the market closes on Wednesday in order to see for yourself how this is so not necessary. Okay, if we are specific with our entries and exits, let's say the market's trading here at the time, and I say this level has to hold. You can use the has to hold link or look up that heading and get a better idea of what we mean by that. But assuming that you've already done that, let's say this level has to hold, and we're expecting a move up to a target at this level. Well, we would wait for the pullback, buy it here up against this level that has to hold. Now, if you do that, great. The inclination is to put a stop somewhere right below this level. That's not necessary, and I'll tell you why. If you observe enough of what we post and how the market behaves relative to the levels that we post, you'll see that's unnecessary, especially for proactive traders. Because if that level were violated, you would see it come back to or through that level, and we would have plenty of time to get back on board for a lower move. But if we're on buy side, what our goal is perhaps to put a catastrophic stop, maybe 3 points or 5 points below us. Now, we never intend to take a hit of the magnitude of 3 to 5 points from our entry. That's why we call it a catastrophic stop. We expect that traders would be proactive enough to be able to manage their trade in a point and a half range, plus or minus, from the area that their entry should be focused. To that end, we think that if you place a closer stop than that, if the market just moves a tick or two against you, you could be taken out for a loss. I hear people want to trade with a tight stop. That means they don't trust the market. They certainly don't trust their read or their ability to read it. And again, it's not your fault. It's the fault of whomever taught you that. If you observe what we do and how we do it, and again, initially, nobody should be trading off of the posts. This is an educational format to show you how this can be done with little to no risk. A point and a half max, never more than 2. So if in between this target, call this our entry, and this is our target for exit, in between there somewhere we will have a TSP level, take some profit, a pair out level, if you will, as per the use of terms. So let's say we have this TSP level here in the center. Once our trade goes to this take some profit level, and let's say you were trading hypothetically with a 3 lot or any multiple thereof at your initial entry, you would pair out, say 2, and then you would place a break-even stop either where you entered or a tick in front of where you entered for the remaining one and then take the final one off at the ultimate target. If we had a rebuy level posted here, you could enter this level with another 3 lot. And if we had an interim TSP here, take 2 off and then have a BE stop on the remaining one, taking it all off a couple ticks in front of this target. In our estimation, that is the best way to manage your trades. If you place your stops too tight, too close to your entry, you're going to get taken out needlessly all the time. That may have been necessary using whatever it is you used before you got here, but if you watch long enough, you'll observe how the market behaves relative to the levels we posted, and there is no panic. No panic in, no panic out. Furthermore, if you place a 3 to 5 point catastrophic stop, I doubt that you'll get stopped out more than once or twice a year, provided, of course, you learn to be proactive in the management of your trades. And again, keep your risk to a point, point and a half. We get a lot of discussion about that. Traders don't understand the difference between a risk and the stop. They are not the same thing. The risk is the risk you manage with your mouse. If you click to get in, you can click to get out. Don't use a device like a stop as a substitute for your brain and your proactivity. Okay, the stop is just in case it all goes wrong. News report or whatever. And as I said, that might happen once or twice a year. For the most part, you should be able to manage your trade to keep your losses at a point, point and a half. There is no perfect science. You can't say I always do this for a point or a 1.50 or 1.25. That's silly. You can't cookie cut the market. But our philosophy is if we don't have the turn within a point or so, that's probably not the turn. So therefore, we say point, point and a half risk, never more than 2. And you can manage that by virtue of being proactive and taking the trades off when you reach that sort of level. The only way you can be in sync with that is by seeing enough examples in the room, watch the posts, generate the levels on your chart according to the trading pad section, and then see how the market behaves relative to what's been posted. I think that will aid greatly in clarifying your understanding and help you see the market in a completely different way. Our traders are pro traders. We show up to trade. We're proactive. But more importantly, we even approach the market in a completely different way than retail traders do. If you have any further questions on this, we look forward to better explaining it during one of our weekly voice chat sessions after the market closes.